Hello and welcome back to Author's Note. The Japanese yen has suffered a sharp sell-off in recent months as a new government has been elected, bringing hopes that the Bank of Japan would act to combat deflation in Japan and weaken the yen. I'm here with Jane Foley of Rabobank. Jane, what have we seen with the yen in recent weeks? We've seen a really big sell-off, but we've seen a bit of a pullback recently because the Bank of Japan has come out and slightly disappointed investors, hasn't it?
I think you could say that the market had seen a lot of hype about what the Bank of Japan could and would do, and we've got some of that. We've got the 2% inflation target, we've got open-ended asset purchases in 2014, but 2014 is still a ways away, and also if you net those figures, perhaps it's not as aggressive as you would have hoped. And also we've still got the 0.1% lending rate. There had been talk that maybe the Bank of Japan would get rid of that and give more incentive for banks not to hold cash.
And so what does this mean for the longer term trend in the yen? If we can just take a look at our first chart here, we've got the yen against the dollar there, and you can kind of see, I mean, that's over the past 5 years, but if you look towards the end of that chart, you see a really big drop off there in the value of the yen, and that's really been since November, just before the government was elected. Everyone was expecting the government to be elected, and so we saw that sell-off, and there has been a lot of talk that the yen could now be used in carry trades because it has gotten a lot weaker and global growth expectations are a little bit better. There's a lot of risk appetite around at the start of the year. Will this recent news from the Bank of Japan derail that theory, do you think?
I don't think it will derail it, and I think the fact is that you're talking about the yen as a funding currency, the better appetite for risk, is actually the primary reason why we're seeing yen weakness. I would say that the talk about the Bank of Japan and what they could do to stimulate growth is a secondary reason. In fact, if you go back to 2012, the first 4.5 months of that year, the yen was the weakest performing currency. Why? Was it because in February 2012 the Bank of Japan announced a 1% inflation target? Some people would say yes. I would say that then was also a secondary factor. The real reason was the LTRO effect from the ECB pushing up risk appetite. At the moment, risk appetite is good, and therefore I think the yen will remain relatively soft, although of course you will have pullbacks along the way.
And if we can look at the second chart, we have a couple of nice things there that do demonstrate how risk appetite is a little bit better at the moment. Jane, can you talk us through the two lines here?
Well, if we look at the blue line, it's the VIX index. If you look at the red line, it's the crossover. It's CDS, a chart of an index of CDS swaps. So these are both at relatively low levels, and these, if you like, are fear indices. They're low because market fear is down. There's a lot of risk appetite, I would say, because of the huge amount of cheap liquidity provided by central banks. As long as the central banks, particularly the Fed, are providing this huge amount of liquidity, the market is perceiving the world to be a reasonable place. So for me, as long as fear is low, the yen will be used to fund carry trades into higher yielding assets. If central banks were to pull back on this liquidity, that's when the story could end for the yen and we could see yen buyers again.
And just lastly on this, high yielding assets, you talk about yield, but of course there's been this desperate search for yield by investors over the past year or two, and yields, particularly on currencies, are coming down. If we look at the last time the carry trade was popular back in 2007, before it all collapsed, you had people borrowing the yen and investing in the Aussie dollar. Well, yields back then on the Aussie dollar were 8% and now they're 3%. Is it really worth a carry trade in these kind of conditions? I
think people are still searching for yield. 3% is a lot higher than 0.5%. So from that point of view, I think that the Australian dollar will continue to hold its own. Certainly I don't expect the Australian dollar to take off. It is already overvalued levels, but counter to many people in the market, I don't think the Aussie dollar will fall back down to fair value. The reason being is that I still think it offers some carry, albeit at much reduced level, and that is still attractive to many investors.
Jane, thank you very much.
Thank you.